inverted yield curves, what do they mean? What do they look like? What do they signal for our economy? How do we get out of them? What makes a yield curve, abnormal or inverted versus normal? Why would one be normal and one not be? We're going to break it all down here in as quick and succinct a way as possible. So let's jump into the current yield curve, which is inverted here in the US, has been for more than a year. We got inverted because of, or at least on the back of, inflation really kicking up, not only in the US, but globally. And so when inflation rises, central banks tend to hike interest rates to slow down that pace of money flying around, to contract the economy a little bit so that we don't go from a healthy economy to a high inflation economy to hyperinflation, and people can't afford goods and services. And so we saw the high inflation, interest rates were hiked. Short-term interest rates rose higher than long-term interest rates as the Fed and central banks across the globe mainly can affect that short-term interest rate, and they hope that the medium and long-term interest rates can tag along with that. And just as a quick side note, whenever I say medium term, I'm talking about 5 and 10 years. And whenever I'm thinking long-term, I'm talking about 20 or 30-year interest rates. And what we saw instead was inflation's up. Okay, the Fed hikes interest rates. Okay, common protocol. 1 month, 6 month, and 2 year interest rates skyrocket from essentially zero, where they were after the pandemic. Because keep in mind, when we see economic slowdowns or potential problems, the Fed does the opposite. They cut interest rates to try to spur growth. And so those short-term rates go from 0 to 3, 4, 5%. And the medium and long-term rates stay around 3 or 4%. They rise with the rest of the curve, but they don't rise as much. And thus we got our yield curve inversion. Now, inflation has lowered, but this inversion has stuck around, partially because inflation is still moderately high. And actually, even when interest rates were moving a little bit lower in the short term, interest rates in the medium and long term were moving lower as well. And so we never got uninverted, so to speak, here in the curve. Traditionally, the more time that is part of a debt relationship, if I'm lending you money for 2 years, then I would maybe say, hey, kick back to me 3%. If I'm giving you the same amount of money and I'm giving you 10 years to pay it back, I might say, hey, give me 5%, give me 6%. That's a normal yield curve. What we've got now is, if you're giving the federal government, if you're giving the US Treasury money, a loan, you get 5.7% for a month, or 5.7% annualized, but brought back for a month. So a higher interest rate per time period for just them having your money for 1 month versus 2 years, 5 years, and what have you. So that's why you would expect a normal yield curve being more time, more interest rate. Right now, it's quite the opposite. It is inverted here. And I guess we can break down now how we got here a little bit further. We talked about the inflation piece, but I want to look a little bit deeper at this relationship and see why we're here now. It seems like the yield curve inversion, given fears of a global recession and a debt ceiling being hit, interest rates should maybe be coming lower. But keep in mind, if there is greater fear of a default, if a company like Apple is downgraded in their credit rating, the next time they try to sell debt to get money in, they're probably going to have to give those people that are loaning them money higher yields, higher interest rates for that same, $10,000, whatever it is, of debt. Because their stuff is in lesser demand. They don't have that higher credit rating. There's a greater chance of a default. And we're seeing a little bit of that right now, whereby the U.S. is up against this debt ceiling. If they don't raise the debt ceiling in time, they could have to default. The U.S. Treasury could have to default on some of its debt. And first of all, if it defaults on, say, the 1-month Treasury bills or the 3-month Treasury bills or what have you, then hell yeah, I would require a higher interest rate right now if I was going to buy that 1-month debt, taking the chance that they default to me on that 1-month debt. But also, just in the grand scheme of things, if they do default and their credit rating is lowered, then again, they would, per every knot on the yield curve there, the person buying treasuries would probably demand a higher yield, right? Like there's going to be less demand. You guys have you went from AAA to AA credit rating. You're going to have to pay me a higher yield. And I get it backwards in my brain sometimes, and I've been around this stuff forever. So I'm sure new people, or relatively new people, it's tough to grasp as well. Whereas less demand in a given debt market like U.S. Treasuries or, Apple's bonds or municipal bonds or what have you, lesser demand, lower credit rating, more risk is going to usually mean higher yields, and more demand, higher credit rating, is usually going to mean requiring a lower yield. And so that's why we find ourselves in this current state of inversion. This was the first run-up and first inversion that we saw. And here you have in black line the 2-year yield, in the red line the 10-year yield. And you can see that amid inflation rising and rising in the later part of 2021 and then throughout 2022, the Fed had to raise the overnight interest rate, which has an influence over all interest rates from overnight to 1 month to 2 years to 10 years to 30 years, but has the greatest effect on the shortest term, right? And that kind of makes sense. It's like if I'm NVIDIA stock, for example, I'm a technology stock, and I move up 25%, I'm going to have the highest correlation, the greatest influence over other technology stocks, but maybe I have some influence over other sectors of the stock market and so forth, depending on how far away those stocks are from NVIDIA. Same with, you raise the overnight rate, greatest effect on 1 month and then 6 months and then 1 year and then 2 years and so on down the line. And so 2-year rates skyrocket from 0% to 4.5%. In the same time, 10 years went from around 1.5% to around 4%, you see there in the right axis in red, and got us to this yield curve inversion of 0.5% between 2 years and 10 years. And that started, the first inversion was because of that inflation and the Fed hiking rates so quickly. Now we're seeing even more of that inversion recently as we get up against this debt ceiling, because it is seen as being a relatively short-term fear. If the U.S. doesn't raise that debt ceiling, the Treasury defaults, and it can't pay its short-term debt, then the interest rates for that debt, the yields for that debt, have been skyrocketing, have been moving in accordance with that risk that of the default. Whereas the 10-year or the 20-year debt, or even the 5-year debt, for instance, the medium to longer term, not rising as much because the fear of the Treasury not being able to pay that isn't as high. And so how do we get out of this? Well, historically, inversions have always normalized one way or the other. And this can, of course, occur by, the 2, 5, 10, and 30-year rising up here, and 5s, 10s, and 30s rising more than 2s, and 10s and 30s rising more than 5s, and 30s rising more than 10s, and so on and so forth. Or what has happened more commonly historically is the short-term interest rates really falling below the medium and long term. And that, as you can imagine, has happened in accordance with economic stress, recessions, and even potential crashes after yield curve inversions. You can go back to yield curve inversion of 2007. And before that, the yield curve inversion of 99, 2000, before the dot-com bubble bust. And so we'll see what happens here. We are still inverted. was partially inflation. Now it's debt ceiling stuff and some wonkiness there. Of course, this curve can just normalize from the medium and long term staying where they are and the short term falling a little bit. But of course, this can occur the way that historically it has sometimes, which is stocks and fear kind of break down a little bit. And the Fed is forced to move short-term interest rates drastically lower. Only time will tell how we get uninverted in our yield curve.